Hello and welcome back to Kitco Mining's Digging Deep with me, Paul Harris, in which we take a closer look at some of the most interesting news items in the mining and exploration space. Joining me today is Neil Adshead, consultant analyst at the Commodities Discovery Fund. Neil, welcome back to Kitco.
Thanks, Paul. Good to be here again.
We have many interesting things to discuss this week, and we're going to start off with silver. Silver converts are on the increase, and no, we're not talking about more people thinking there's going to be triple-digit silver prices, but silver companies raising what looks like incredibly cheap debt. 3 companies have raised about $1 billion between them in convertible notes. First Majestic Silver, Endeavour Silver, and Vizsla Silver each sought to raise about $300 million. First Majestic priced its notes with interest payable at 0.125% per annum and a conversion rate with a 42.5% premium. Endeavour priced its notes at 0.25% with a conversion premium of 32.5%. And Vizsla, which is a non-cash flowing developer, priced its notes at 5% with a conversion premium of 25%. Neil, it seems that there's some very low debt pricing here and healthy conversion premia. What does this perhaps say about investor appetite for silver stocks?
Well, first on the Endeavour Silver convert, I had lunch this week with a friend, a business contact of mine who works at Endeavour, and he told me about the convert, and I was shocked when I heard about it. 25 basis point coupon, and an exercise price on the shares that's 32.5% above the current share price. I just thought, well, who in it? Well, one, at first I didn't really believe him. I had to go and look up the news release, and then I kind of discussed it with a couple of people. And I was kind of shocked. I thought, well, who on earth would buy this piece of paper just for 25 basis point return? But yeah, I mean, I agree. Apparently the demand was very strong. The $300 million went out the door immediately. They upsized it to 350. That sold straight away. And I don't really understand who would buy that piece of paper when you could buy a T-bill or a GIC in Canada and earn at least a few percentage points. Yeah, there must be some pretty roaring silver bulls out there that believe silver equities at least are going to go a lot higher. Otherwise, why would you buy that piece of paper given the piddly returns?
Well, I guess that's indicative that they don't necessarily want the returns on the paper. They want the stock, they want the convert. And that perhaps suggests that those particular investors and a lot of investors in the silver space in general think the silver price is going to go much higher than the record, $60 per ounce that we're at today.
Yeah, I'd say so. Yeah, I mean, it has to be. Why else would you buy that? I'm still scratching my head, and there's a couple of other financial types around town I've discussed those converts with. Again, are kind of wondering, is there something we're not seeing here in the background as to how or why basically $1 billion has been invested into those 3 converts? It has to be people believe the silver equities are going to give massive leverage to the silver price.
I think it's one thing to have a very low coupon on a cash flowing producer, but as I mentioned in the comments, Vizsla Silver, it's a developer, it's got to build its mine yet, and getting 5%, effectively 5% debt to build a mine, that's almost unheard of.
Well, it's excellent in Mexico, yeah, for sure. I mean, the sort of a consensus view is that Mexico is, say, a little bit riskier than what it was several years ago. Being able to raise capital there to build a decent sized mine in Mexico, it's not that easy to raise it at the money. That easy to raise that amount of money at the moment. So all credit to Vizsla. They're taking advantage of what is clearly a warm market, and I'm assuming there's a lot more money that wants to come into stories like this to gain exposure to the silver price.
I think it's worth highlighting that the blue chip note in the mining space are typically the bonds that Chile state copper company Codelco issues. Vizsla's 5% is just a little bit higher than Codelco can get in the market. Codelco's notes aren't convertible, of course. Let's turn to Barrick Mining. Barrick has authorized its management to explore splitting the company with the possibility of spinning out low country risk North American assets into a new company. This would include Barrick's share of its Nevada Gold Mines joint venture, its red-hot 4-mile development project just next door, and its Pueblo Viejo mine in Dominican Republic, where production is set to expand to about 800,000 ounces per year. Neil, where do we start with this? Elliott Management has taken a big stake in Barrick, and according to news reports, it really wants to force the split into two different Barrick companies. And if this news, announcement actually goes into concrete a deal, it seems like Elliott and other shareholders are going to get their way.
I'd say so, yeah. Elliott is a very famous, renowned activist investor. Clearly, it's done its homework. It sees where the gold price is and where it thinks the gold price is going. It sees Barrick as maybe it's a big brand name in the gold sector. It's been around for a long time, despite changing its name from Barrick Gold to Barrick Mining at possibly the worst time. But clearly, Elliott must see that there's a lot of value in the components of Barrick, but maybe not necessarily the same value in Barrick as the company as a whole today. So splitting it up would, to me anyway, probably would make a lot of sense, and obviously Elliott making the same move. So there's lots of permutations how you may split that up, and it'll be interesting to see how that plays out through 2026.
Now, Barrick is a massive company. It's got many, many mines. It's got many, many assets across pretty much every continent. So it could be a case that splitting up into constituent parts realizes more value than keeping them all together. Grouping the particular assets we talked about in North America into one company, that could create a monster gold company with a monster valuation. What for you makes sense about grouping these three assets together?
Yeah, I think if you could generate a company, North American focused, New York listed, with what's perceived to be relatively low risk assets, producing 3 to 4 million ounces a year with long mine lives, I think that would be warmly received, especially from North American investors. And I suspect it would trade at a significant premium to its peers.
Okay, now let's put another twist on this. A little bird tells me that you're a fan of Romcom movies, and boy, do we have a good one here. Barrick and Newmont flirted with each other in Nevada for decades to put their assets together in a will they, won't they dance, which was finally resolved in 2019 through the creation of Nevada Gold Mines. In any good rom-com, there is a twist, creating more will they, won't they tension. In this case, Barrick has the right to vend in its spectacular 4-mile asset into Nevada Gold Mines at market price, which potentially creates a tough decision for Newmont. They can either pay billions to their main rival or dilute their stake in what is one of its major assets. And now there's a new curveball in this relationship. What will happen if Barrick spins out its assets? Presumably Newmont will have the potential and perhaps the opportunity to vend its joint venture interests in Nevada Gold Mine and Pueblo Viejo into the newco for stock in it, or it could obviously maintain its current joint venture interests. Neil, we're perhaps as close to a nail biter as we're going to get in the mining space. How do you think this is going to play out?
I'm not sure, because if you think it through, and as you were talking about it then, there's so many different permutations here. You know, the NGM, the Nevada Gold Mines JV, it's basically, I would say, the flagship asset for both of those companies. So for one of them to sell their significant interest, I think Barrick's at 61.5%, Newmont's got the remainder. So they are material assets, mining assets inside the companies, inside both companies. I can't see under current market conditions why either company, you asked specifically about Newmont. I'm not sure why Newmont would vend in their ownership, let's say for cash. Maybe they'd vend it in for shares, and all of a sudden their gold production has gone down. You know, it's a significant producer for Newmont. I just don't really see why either company would walk away from that JV. So I'm not really sure how it's going to play out. I'm sure there's many bankers sharpening their pencils, earning nice fees with multiple permutations here. It will get worked out. Maybe nothing will happen until Barrick brings a new CEO in, which would make sense. And let's see what that new CEO decides to do. So The bottom line, I don't really know. Would be interesting to be in the discussions. I think there's so many different permutations here. I agree. It will be quite an interesting soap opera to follow through next year.
Now, with Barrick having the put option on 4 Mile into Nevada gold mines, as and when it does that, Newmont potentially will have to stump up billions of dollars to pay Barrick. So, is there possibly a non-cash solution for Newmont here?
Well, if I was Newmont, in a way, it's an opportunity to, for want of a better word, to get rid of some cash. If you look at how much cash Newmont is generating through 2025, it's huge. Billions and billions of dollars. They've bought back so much stock. They've repaid all their debts. If anything, Newmont, the board is probably looking at the balance sheet, thinking, and the cash flow statements, thinking we are going to generate billions of more dollars. What are we going to do with it? Just having a nice little opportunity here to invest in a significant new discovery in Nevada, I actually suspect they would be quite happy with that, because it's a good use of cash, just to garner exposure to future gold production from what looks like a top quality tier 1 asset in a great jurisdiction.
Now, this is obviously a clear one, clearly a champagne problem for Newmont to address. Newmont is still seen as the US gold producer, although Nevada Gold Mines is its main or only US asset. Does that create pressure on Newmont not to dilute its ownership position in NGM?
Yeah, definitely. As I said before, I don't know why Newmont, even though they are the minority partner there, why they would walk away from this significant production center. I believe the JV produces more than 3 million ounces a year. It's got significant life. It's got huge land position. Newmont is not really looking to sell out of any assets like the JV at the moment. If anything, they would prefer to have more gold production and less cash building on the balance sheet. So I can't see Newmont walking away from that.
Okay, let's turn our attention to higher country risk Barrick, and a couple of news items out recently about that. Barrick has settled with the government of Mali and will pay the country $430 million, among other things, so that it can restart the Loulo-Gounkoto gold mine that accounted for 14% of its production in 2024. Elsewhere in the Barrick portfolio, Appian Capital Advisory provided $150 million to support Atlantic Group's buyout of the Tongon mine in Côte d'Ivoire from Barrick, in a deal worth up to $305 million. Neil, a couple of transactions here, a couple of news items here. Does this suggest, and given in the context of what we've just been talking about, that higher risk Barrick may be dismantled and portioned out, and brings to mind the fact that Newmont sold 6 mines in 2024. Could we see a similar rationalization with higher country risk Barrick going forward?
I wouldn't be surprised. Again, going back to what we were discussing before, I think groups like Elliott that build a big enough share position will be putting pressure on the Barrick board to maximize value for shareholders. We're waiting to see who the new CEO is, what direction that individual will take. But I wouldn't be surprised, because if you look at the other assets in Barrick outside of North America, it is, I won't necessarily call it a hodgepodge. And Barrick, if you look over the last few years, they have sold quite a lot of assets. You can think of Skeena and Kainan 2 and various other assets like that. So in a way, Barrick has been rationalizing some of the, let's call them smaller, disparate assets, and I wouldn't be surprised if this keeps going. But again, it depends. Ultimately, shareholders will have a big say, the board will have a say, and let's see what the new CEO has to say once that person is in the role. Because the company today, a lot of it was driven by Mark Bristow's drive and decision making and direction with the board. But that's now all changed. So who knows what Barrick will look like in the future.
And I think a not unimportant point to add to that, Neil, is, Mark Bristow circumnavigated the world several times a year, visiting all of those projects. That's a pace of work that perhaps not many people would want to take on. So for the new CEO, they may, just for personal reasons and just not to be completely exhausted and on a plane all the time, may suggest a different direction. Well, let's switch to copper. Glencore had its Capital Markets Day recently, and CEO Gary Nagle spoke of plans to expand copper output to about 1.6 million tonnes per year by 2035 and reverse a multi-year slump in output. The company also cut 1,000 jobs as it targets $1 billion in cost savings by the end of this year. Neil, at Glencore's last Investor Day 3 years ago, Gary Nagle said that Glencore would build its copper pipeline, and I quote, when the world is screaming for it. The copper price is at a record of over $5 per pound. Is the world now screaming for Glencore's pipeline?
Well, the world does need more copper. I think we've all read multiple reports, BHP and various government groups and various analyst groups, forecasting this looming and growing deficit through, let's call it the 2030s. I think the challenge with copper is the projects tend to be very large, and by that I mean they need billions of dollars of capex. Most of the good ones historically have been built. Obviously, a higher copper price helps the bottom line in some of these, but the big upfront capex requirement, the relatively long paybacks, even at $5 copper, we're just not seeing too many companies at the moment stepping up to want to spend $5 billion to produce 100, 200, 250,000 tons of copper a year. I'm not seeing anybody do that yet. And the ones that were built recently, you saw QB2s with Teck there and Cobre Panama. They've had issues. They've had issues getting payback. They've had issues for softer reasons, let's say, in Panama. And I just think there's boards there that they're a little bit concerned making the decisions to invest billions of dollars just because they don't really see a clear pathway to a relatively quick payback and a nice financial return. So I think most of the investments we're seeing right now, they're just trying to maximize the production from their existing assets, but you can only do that for so long. And ultimately, eventually, we're going to have to see some of these majors step up and build these mines. We're just not seeing it yet. Maybe, for years, people were saying the incentive price is $5, $6 US a pound. Maybe it's $8, maybe it's $10, and it needs to be sustainably at a level like that. And maybe only then we will see some of these majors with the pipelines pulling the trigger and or buying some of the juniors that also have development projects in the copper sector.
Okay, now Glencore has a multi-asset project pipeline with projects in Chile, Argentina, Peru, and other places. But I think it'd be fair to say that there's a fair amount of hair on those assets. Each of them has challenges to surmount in terms of permitting, social, and other things. So is there an element here of, Gary Nagle's obviously talking his book, but, to what extent do you think could Glencore actually deliver on that?
That's a difficult question because obviously every project's different, and I don't really know these days inside Glencore or inside other copper developers, let's say Codelco or Teck, whether these teams, BHP, whether these groups have top-notch operational, mine development teams. We're seeing quite a few mines these days. Same in gold, actually. The mines, we see a feasibility study. The mine gets built and then the capex is 50%, 100%, 200% higher than what the forecast was, which if you were to put that into the financial model in the feasibility study, the economic returns would be significantly lower. So it's kind of an interesting dilemma right now. It's like the world needs these resources. The mining companies kind of have a pipeline of projects. The projects, as you said, do have hair on them. And we're seeing these capex blowouts, which are quite difficult to manage, quite difficult to stop happening. Investors don't really like them because obviously they tend to hit the share price through additional equity dilution. So it is a bit of a dilemma at the moment. I don't think you can put your finger on any of these majors and say, these guys are excellent mine builders. We should back them. I'm not really sure what the solution is. If anything, we're seeing more mine builds run over time and over capex, and that's making people a little bit nervous about writing these multi-billion-dollar checks to build the next copper mine, wherever it may be.
Well, one answer to the development dilemma and the risk that entails is to buy capacity, buy production from somebody else. Glencore tried and failed to take over Teck Resources. Copper was a large part of that effort. And Teck is now tying the knot with Anglo American, and copper is front and center of that deal. Neil, to what extent could there be potential for Glencore interference in that deal?
There could. I don't really know whether there will be. Obviously, Glencore must be friendly with Teck because they bought Teck's met coal division in BC, British Columbia. BHP looked at Anglo a couple of times. That didn't happen for whatever reason. So these majors can sort of dance with one another for only so long. They kind of run out of things to acquire. At some point, I don't know when or who or which asset it's going to be, but we're going to see one of the big boys is going to actually commit to building one of these mines. And unless I'm mistaken, I can't really think of any big copper mine anywhere in the world that's being built at the moment. I mean, maybe one that's being built. There's plenty in the pipeline. I think the USGS says something like there's 40 to 50 years of reserves, copper reserves in the world. So there's no shortage of known copper. It's just we do seem to have this big moat, this sort of decision moat around these projects that even though the majors have got tons of money, they're not pulling the trigger to build them, to bring on the copper supply, let's say for, in 5 to 10 years time. They're all sort of looking at one another, and ideally, as you say, they're trying to buy production, but there isn't really much left to buy. All the mid-tier copper guys have gone, really. Maybe Capstone or somebody like that gets acquired, one of these smaller, mid-tier producers. But yeah, it's a challenge at the moment to see who and where the new copper supply is coming from, even though there is a lot of known copper out there.
Or maybe we have the makings of another mining Romcom between Glencore, Anglo American, and Teck. Glencore has also signed an MOU with Chile state copper company Codelco to increase copper smelting capacity in Chile. The project contemplates a plant capable of processing 1.5 million tons per year of copper concentrates, with Codelco to supply 800,000 tons per year of those for a minimum of 10 years. Glencore owns the last smelter to be built in Chile, which is Alto Norte, which it obtained through Xstrata Copper more than a decade ago. Chile faces higher copper concentrate production in the future as leachable oxide ores are depleted, but its concentrates are becoming more complex with higher levels of arsenic. The smelting business is typically low margin, and the treatment and refining charges that miners pay smelters have become negative this year because of a concentrate shortage. Neil, is developing a new smelting capacity a good idea at this moment in time?
I think maybe today it doesn't look like the best idea, just based on the history of smelting. As you said, it tends to be low margin and kind of cyclical. But I think if you're going to build a smelter anywhere, building one in Chile, on the coast, as you said, lots of future or an increasing amount of copper supply out of Chile is coming from concentrates. The Chilean power grid, the power rates due to solar, etc., have dropped significantly. No doubt there's government incentives from the Chilean government, maybe the American government as well, to develop more smelting capacity in the Americas, maybe in Europe too. So I think long term it's a smart move. Maybe short term it doesn't look that smart, but it is kind of interesting to see, if Glencore is making that decision to invest money in building a smelter, but not invest money in bringing on new production from projects in their pipeline. So I would say yes, long term, maybe even though today it doesn't look super smart.
Now, Chile's been talking about building a new copper smelter for at least 25 years since I lived in Santiago. And, I think it's not worth overlooking the fact that Codelco receives considerable premium for the copper it produces for its copper cathodes. So there's potentially a way out there to overcome the very low TCRC environment we're in. Produces its own copper, as you say, very low energy costs and clean energy, because presumably that will all be under PPAs with renewable energy sources. And of course, you're taking out a whole bunch of concentrate shipping to add to the environmental benefits of smelting in Chile. Let's continue with copper. SolGold rejected 2 acquisition proposals from 12% shareholder Shaanxi Copper. SolGold is advancing its Cascabel project in Ecuador towards a production decision. The 2024 pre-feasibility study estimated an initial 28-year mine life with an average production of 123,000 tons per year of copper, 270,000 ounces per year of gold, and 794,000 ounces per year of silver, potentially production starting from 2028. Shareholders in SolGold also include diversified miner BHP and Newmont. Neil, given the context of what we were just talking about, it's good to see copper developers getting acquisition bids.
Yeah, definitely, 100%. I believe it was an all-cash bid, obviously Chinese copper producer. Why they turned it down, obviously, I don't know. I wasn't in the boardroom, so to speak. It was quite interesting reading that national security piece that the White House put out a couple of days ago about the US kind of wanting, to be in, not necessarily in control, but the Western Hemisphere is theirs, so to speak. It's their playground. They don't really want too many big foreign actors coming in. Maybe there's a bit of geopolitics here too. Maybe there was a call to SolGold to say, do not let a Chinese company buy this asset. We will help you build it, kind of scenario. It would have been a pretty good purchase. I think it was roughly around about $1 billion if Jiangxi would have been successful. The stock reacted well when SolGold turned it down. I believe it's up 10 to 20% subsequently. And I just think these assets ultimately are going to get built. I suspect maybe we're going to see Chinese bids for assets in the Americas be rebuffed for whatever reason is going on in the background. We're just maybe never really going to find out the real reason. But I don't know. I suspect it's a bit of a trend we're going to see. I suspect we're going to see more American money pour into Latin American copper developers to secure the supply for the United States, essentially.
Well, I think there is a trend there. If we go back to 2024, also in Ecuador, Solaris Resources had secured $130 million US investment from Zijin Mining, which was rejected by Canada. Solaris subsequently re-domiciled in Switzerland to avoid that becoming a problem in the future. One of the curious aspects here, and I think you sort of touched upon it, Neil, SolGold has been looking for a transaction for ages. So it is curious that when an offer came, it passed on it. Much more to come in that story, I believe. Now, let's talk about another development asset, and Skeena Resources' Eskay Creek Gold Mine. That's in the spotlight now after the Tahltan Nation offered its members 10,000 Canadian dollars each ahead of a vote on the mine and whether to vote to allow it to go ahead. It's the first mining project to face Canada's first ever consent-based decision-making agreement with a First Nation. The impact benefit agreement that Skeena has negotiated with the Tahltan Nation includes aggregate cash payments of $1.2 billion over the mine's life, as well as $570 million in contracts and wages. The Tahltan are also pushing the provincial and federal government to ensure such payments are exempt from taxation. Neil, why was this news of this financial package, why was it so polemical?
Well, it's kind of interesting. It's a complex and interesting topic. When I read you basically read what the Tahltan released, and it wasn't released by Skeena. Essentially, the Tahltan Nation will be paid 40 million Canadian by Skeena. Essentially, might sound a bit harsh and cynical, but essentially to provide their approval to allow Eskay Creek to be developed. And I think without the Tahltan, approval here, this project is not going to advance. So, there's all sorts of ways you can view that payment, and essentially, I think the payment, the number was worked out so that every Tahltan member of the First Nations receives 10,000 Canadian dollars. Now, there's people in the Tahltan that don't particularly like this either. So it's kind of it's going to be interesting how this turns out. And I believe there's a vote by all the Taltan members in the next week too, as to whether this impact benefit agreement is acceptable, if that's the right word. And that's kind of interesting because the First Nation here essentially does have a veto over this asset, and if they choose not to, if they don't like the terms, obviously they can be renegotiated, but they're essentially holding the company a little bit, let's say to ransom. Let
me stop you there, because I want to go into that veto aspect in a moment. But just on this, the Taltan, I read the Taltan news release, and the Taltan leadership said the terms in that were in response to requests they had received from the members. And putting this in a broader context, it is not unusual to have some kind of a signing bonus in the mining space. And I'm drawn to think of, every 3 years, the major mines in Chile go through collective bargaining with their unions. And whatever the agreement is in terms of, holiday pay, etc., bonus, they always include a signing bonus. So in that context, there's nothing unusual here, even though, as you mentioned, some critics of it accuse the Taltan and Skeena of perhaps buying consent.
Yeah, it's a bit different to the Chilean scenario, because the Chilean, you're basically paying the workers. You're paying the people who are doing the work at the mine. You're not paying, the Taltan here is essentially like a regulator, if you think about it, because the Taltan essentially has a veto over this asset. So another way I can look at this is if a mining company I was involved in went to Africa, let's say, and paid 40 million Canadian dollars to a government, a regulator, to give me permission to build that mine, I think I'd quickly be arrested for a Foreign Corrupt Practices Act. So it's sort of a bit of a grey area, and I'm kind of intrigued to see how this plays out. I don't really, obviously, I'm not inside the tent on either side. I don't really understand fully how the negotiations have progressed. All I can do is follow the public disclosure, but it's going to be kind of interesting to see how this plays out. It's setting a interesting precedent that we might see in future, whereby before a mining company is allowed to develop a project, they're providing significant, material amounts of capital to essentially regulators, local communities, to give them approval to allow them to build and operate the mine.
Well, I suppose there is always the argument that impact and benefits agreements essentially are a way, or the tool that miners use to buy consent with their host First Nations. In getting onto your comments that I rudely interrupted about veto, Neil, the constitutional obligations to engage with First Nations and to obtain consent for project development means, as you said, First Nations effectively have a veto over project development. And we may see this used elsewhere in British Columbia as Premier Mark Carney aims to develop a new heavy oil pipeline to carry more than 1 million barrels a day of oil from Alberta's oil sands region to the Pacific coast in British Columbia. Some of the First Nations there are not happy about the prospect of having an oil pipeline go through their territories. With First Nations having a veto, it does seem that the cost of business in BC and elsewhere in Canada is going to go up. And it potentially means that First Nations can essentially name their price to allow a project to go ahead.
Yeah, definitely. Now, most prior investment benefits agreement have involved, they generally focus on things like employment and training and contracts, sort of catering contracts, even mining contracts, various other contracts. This one feels different because there's a significant material upfront cash payment, as well as all the contracts that basically are going to come with this. It just seems like this one's gone to a new level. And again, so I'm kind of intrigued to see ultimately how this plays out. I don't really know how it's going to play out, but generally when you start to go on a trend in this direction, it only tends to go in one way until, I don't know, somebody at some point says, enough, as in, are we going to see this next time? And all of a sudden you're handing over $100 million. So it's kind of intriguing. It is a new development. It's a material development. And it's going to be fascinating to see how this plays out in the next few years, especially in BC, with the local First Nations groups.
Now, there's a critical minerals aspect to this as well, with the government really sort of keen on pushing that. But with the First Nations potentially or having veto rights, again, they could potentially demand, whatever they like to allow this to go forward. Neil, to what extent is there perhaps a parallel here? If we go back to the 1970s, the oil sector, if you go back into the history of oil companies operating in the Middle East, initially they obtained the vast majority of the profits. The countries eventually woke up to that, and there was a landmark epoch, if you like, when there was a 50-50 profit split. And then going into the 1970s oil crisis and beyond, the countries realized that, hang on, this is our oil, we're going to have the vast majority of the profits, and the companies can have the leftovers, if you like. Is the mining space with things like this going in that direction?
I would say definitely, yeah. Security of supply. You're going to be paying more for your materials, let's say, if the host community, host government wants more of the pie. Obviously, you can't move your mine to a lower tax jurisdiction, so to speak. So if anything, the one takeaway from all of this is it's definitely going to be inflationary, and it's definitely going to result in higher commodity prices across the board.
Okay, we've covered a lot of ground today, and I think we've covered quite a lot of ground this year, Neil. I really appreciate you sort of participating in this every month or so. Let's end with a sort of quick question for you. What do you think was the biggest story in the mining space this year?
One that caught my eye, and it's still playing out. It's kind of interesting to see Tether pop up and be a significant buyer of bullion. This sort of non-government entity, like a big, let's call it a corporate entity. I saw there was a graph came out a couple of weeks ago that showed Tether bought more gold in Q3 than any, and this is physical bullion, bought more gold than any central bank in the world. So if more of these corporates, whatever business they may be, decide to put gold bullion or even silver on their balance sheets, that's a new source of demand in the precious metal sector, and I thought that was quite fascinating, and I'm interested to see how that plays out going forward.
Okay, and what are you looking forward to in 2026? What do you think will be some of the key investment themes or news points next year?
I mean, we've already talked about copper and the sort of let's call it the bulging development pipeline, but nobody wants to sort of make a decision to build a new copper mine unless I'm missing one or two there in the world. So I'm kind of intrigued to see at what point I wake up one morning, who's made the decision to spend $5 to $10 billion building one of these large low-grade copper mines in the Andes or wherever in the world. So I suppose I'm waiting to see that moment, and it'll be maybe wait to see how high the copper price has to go before one of these majors makes the decision to build a next new big copper mine.
Well, that's certainly something I'm going to be looking out for as well, Neil. That's it for this week. Neil Adshead, thank you very much for joining me today.
Thank you, Paul. Always a pleasure.
And of course, to our viewers, if you like what you see, hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.